It feels like the economy is telling two totally different stories right now, doesn't it? Well, in this explainer, we're going to dig in and try to figure out what's really going on. You know that feeling when you're getting completely mixed signals? Well, that was the economy yesterday in a nutshell. I mean, on one hand, you had Oracle's stock just exploding, up 26% after hours, all thanks to this massive AI hype. But then, literally at the same time, one of the most powerful people in all of finance was sounding a completely different alarm. And that's Jamie Dimon, the CEO of JP Morgan Chase. His take is the polar opposite of all that tech euphoria. See, he's not just throwing out an opinion here. He's looking at the actual data from millions of customers, millions of businesses that his bank deals with every single day. And he's seeing a slowdown. So, what gives? How can you have this massive tech boom and a serious economic warning happening on the very same day? It feels like a paradox, right? Well, to get to the bottom of it, we've got to look at these two powerful and totally opposing forces that are shaping everything right now. All right, first up, let's talk about the engine. What is driving all this incredible growth? And you might be surprised to hear, it doesn't actually start with the machines. Nope, it starts with people. Just let that sink in for a second. A 50% increase in just 1 year. That is a huge migration of talent into some really high-paying jobs, and it's creating these new pockets of wealth in some key cities. And look, this isn't just some abstract number. This talent boom is having a massive, real-world impact. We're not just talking about Silicon Valley anymore, not by a long shot. In major AI hubs like Manhattan and DC, apartment rents have just skyrocketed. We're talking over 14 and 12%. The AI money is definitely spreading its wings. Okay, but all that brain power needs some serious horsepower to back it up, right? This whole AI revolution isn't just happening on a bunch of laptops. It requires this gigantic build-out of both physical and digital infrastructure. And that means one thing and one thing only, spending. A lot of spending. And when I say a lot, I am not kidding. Just look at this number. Microsoft just inked a deal with an AI infrastructure company named Navius, and it could be worth up to $19.4 billion. I mean, that is the kind of money that literally creates its own economic gravity. And hey, this isn't all just some far-off promise of future profits. The tech giants are already cashing in. They're turning these massive investments into actual revenue right now. Take Google. They've got this super clear 3-step playbook. They charge you to use the models, they sell you subscriptions for their tools, and then they're constantly trying to upsell you to the pricier, more powerful stuff. All right, so that's a pretty compelling case for a major boom, right? It's hard to argue with those numbers. But now we have to flip the coin and look at the other side of the story, because there's a whole different set of data out there. And frankly, it's flashing bright red. This number right here, it sent an absolute shockwave through the financial world. So the Bureau of Labor Statistics, the BLS, they went back and revised their own data. And what they found was that the job market we thought we had over the past year, well, it wasn't the real story. The reality is it was much, much weaker the entire time. And this brings us full circle, right back to where we started. That jaw-dropping revision from the BLS, that is the exact data point that made Jamie Dimon come out and say, hey, the economy is weakening. He's looking at this number and seeing a crystal clear signal that the economic foundation is way softer than it looks on the surface. So, okay, we've got a weakening job market. You'd think that would mean prices would start to come down, right? Well, not so fast. The upcoming inflation reports, both the CPI for what you and I pay and the PPI for what businesses pay, they're both expected to keep going up. And that combo, fewer jobs and higher prices, that is a brutal squeeze on pretty much everyone's wallet. And if we kind of zoom out from the day-to-day stuff, there are some big long-term headwinds blowing too. Take Social Security. The date when its trust fund is expected to run out of money, it just got moved up by a full year. So after 2032, the system is only projected to have enough cash to pay out about 77 cents for every dollar it's promised. That is a massive structural problem that just adds another layer of uncertainty to the whole mix. So you've got these powerful forces pulling in opposite directions. The big question is, what are major companies doing about it? How are they navigating all this? Well, they are definitely not just sitting on their hands. They're making some huge, calculated bets to try and find their way through this really weird economic moment we're in. Let's look at Apple, for example. For the first time since 2017, they're hiking the price of the Pro iPhone in the US. Now, sure, part of this is just about managing their own costs, but it's also a really high-stakes gamble on a pretty simple question. When the economy feels shaky, are people still going to be willing to shell out top dollar for premium tech? We're about to find out. And then there's another huge bet happening over at Microsoft. Their head of HR put it this way. They believe the race for AI supremacy is going to be won by harnessing the energy and momentum that only happens when people are working together, side by side. And they're not just saying it, they're putting a major new policy in place to prove it. So the company is now officially requiring employees to be back in the office 3 days a week. It's a huge strategic wager. They're betting that the next great breakthrough in AI isn't going to happen on a Zoom call, but when smart people are actually in the same room, hashing things out together. But for companies that are super connected to the everyday person, the story's a little different. It's less about making these bold, futuristic bets, and more about just trying to navigate some really fragile consumer sentiment. I mean, you've got Cracker Barrel having to completely walk back a logo redesign because of social media backlash. And Starbucks, they're finding out that their big turnaround plan to win back customers, it's just taking a lot longer than they hoped. And as if all that wasn't enough to juggle, there is a massive wildcard just looming on the horizon. There's this huge legal challenge, and it's arguing that some U.S. tariffs were put in place illegally. It's now headed straight for the Supreme Court. And get this, if the court sides with the challengers, the government could be forced to refund close to $1 trillion. Talk about injecting some serious, unprecedented uncertainty into the system. So, where does all this leave us? What are we supposed to make of it all? Well, you've got this booming AI engine pushing us forward on one side and some pretty serious economic brakes being slammed on the other. It really all points to one key takeaway. Right now, we are living through a time of just incredible economic tension. Look, at the end of the day, it really just boils down to this. You've got the AI engine, which is like rocket fuel for the economy. It's powered by talent, unbelievable investment, and genuine innovation. But at the exact same time, you've got the macro brakes being hit hard. A weaker job market, inflation that just won't quit, all trying to slow the whole thing down. And that leaves us with the ultimate question, doesn't it? There is absolutely no doubt that the AI revolution is here. It is real, its economic impact is already massive. But is that one single engine powerful enough to pull the entire economic train forward, even while the rest of the economy is trying to slam on the brakes? That right there, that's the billion-dollar, maybe trillion-dollar question that's going to define everything that happens next.